So, dude, I know you're fast becoming a cricket fan.
Yeah.
Have you ever heard of the term reverse swing?
I don't know.
Reverse swing is kind of one of these dark arts. It was pioneered by the Pakistanis, and it's flummoxed batsmen of all stripes for decades. And I kind of thought of it again because of what the Pakistanis are doing at the Roosevelt Hotel in New York City.
It's very unpredictable and sort of all over the place. So yeah, sounds right.
Welcome back to the Promote Podcast, your insider guide to the money and mania of the CRE markets. Hiten and Will here as always. There's so much to discuss.
Quite a lot.
JPMorgan's making a play for the Roosevelt Hotel. A deal would mean the mighty bank controls over 7 million square feet of prime midtown space.
Almost enough to fit all of Jamie Dimon's ego.
But with the Pakistani government on the other side, it's not going to be that straightforward. Starwood is in M&A mode. It's buying Brookfield's triple net machine, and multifamily giants Bell Partners and Cortland are getting their summer bods ready for suitors.
Excited to dig on these.
A shout out to our sponsor Vesto, which gives CRE players a single, clear point of access for all their bank accounts. You'll hear more on them in a bit. Since we always get accused of favoring New York,
I mean, why wouldn't you?
we definitely are partial, but we always start with New York. Let's go all the way south to kick this off. Let's go to Greensboro, North Carolina.
I love it.
What's going on there?
So Bell Partners is putting themselves through a process, not just selling the assets, their portfolio, or their management company. They're selling the platform, the OpCo it is.
Yeah, it's a little bit unclear on what exactly they're doing. All we know for certain is that they've hired an external firm to explore options, bringing in a capital partner, an outright sale, or like a sale of an arm of the business. It's not clear exactly what they're doing.
I think there's a lot of ways to play this because you can either sell the assets that they own, which are capitalized by either fund or various capital partners. You can sell the property management company, which generally those don't trade at enormous multiples because it's sort of a very hard business.
It's like predicted. Yeah, there's not that much upside. Yeah,
but it's predictable, and there is value to that. So if you look at Starwood taking Milestone private, like people ascribe value, like real value, to those platforms.
Yeah.
Or for Bell, I mean, I think there's also value just to their dev machine. So someone can buy into their pipeline and look to capitalize it over time. So I guess a little bit unclear as to what's going on. But if they were just selling their existing portfolio, they'd probably pick any one of the typical...
Yeah, I want to see BRE or et cetera, right?
Yeah, it sounds like they're hiring corporate bankers.
It seems like they're hiring an iBank. Again, we don't have that name yet. On the other hand, though, and I don't think you know this, Will, yet.
Breaking news.
Breaking news happening right now.
Breaking news first.
Breaking news.
Ooh.
Cortland, which is a lot bigger, Atlanta-based giant, they are also going through a process right now, and they have hired Evercore to help them figure out exactly what's what.
Wow, so that's
a little bit of news right there.
Yeah, you guys can't see me, but I'm a little startled. I don't know what to say.
So Cortland's a very big deal. This is about 75,000 units that they own. So they're, I think a top 10 landlord in the country. And Steve DeFrancis has built quite a machine. And I think the idea here from sources that the Promote's spoken to is there's so much money flowing into the space, so much private equity money, retail money, etc. What are we worth? Can we get a bigger war chest? With Cortland, I think the idea is to basically retain control unless it's some sort of stupid money offer and just kind of expansion fuel. That's the play that I've been told this is.
Interesting. So I'm not like on a first name basis with him. Steven DeFrancis has built...
He's a G.
He's built an incredible machine. I mean, I think you can listen to him, I think, on the Walker webcast from like a couple years ago during COVID. And he's talking about how like they vertically integrated their sourcing of like marble for all of their unit renovations because they do so many of those per year, and they have standardized all of that. And, they're very focused on like being top owners in their markets and made a ton of money for people and for themselves.
They're a cash cow. I think they're also pretty quiet giants. I think partially because of where they're headquartered, they kind of fly under the radar. There have been two big news events related to them. One is they're one of the central landlords in that whole RealPage lawsuit, the crackdown on those big landlords. And I think they were the first ones to settle and figure something out with the DOJ. So that's one. The other one is a little more, it's smaller, but more fun for us. they've stepped into a flow deal.
Yes, they have.
And they did Rescue
Fantastic.
Pref and Buckhead.
That's in their backyard. They're very creative. They can operate stuff, which is sort of how you're going to really do deals at scale right now, is figuring out creative ways to get into the capital stack and take over versus just sort of waiting and paying the highest number to, in a brokered process. That's just sort of what's going to happen right now. I think it's really interesting. I think Cortland in particular, because that business is, fees coming in, like they have a fund series, they're vertically integrated. I don't blame him for doing this because they are playing offense right now. They have made it through a couple of cycles and, incredibly highly thought of, seen as a
very, very good operators, I think, right?
Seen
That's
as
the
a
reputation.
very well-run company. There's such a low supply of good things to buy at scale that if Cortland comes out, it's the same story in the multifamily market right now. I can't tell you the number of institutions I talk to that say like, oh yeah, we're looking at 6.5 cap buys in like prime Buckhead. Like, sure you are, guy, whatever. Good stuff trades low 5, high 4, even a little tighter, tax adjusted.
You're not wrong. From the numbers I've been hearing recently, that's right in the range.
No, that's exactly right. And Cortland is the same thing. Yeah, it's a tough M&A market. Yeah, people are uncertain about a lot of things, but if you have a great company and there's no other great companies that are going to take people's attention, I guess we're talking about Bell, so there's two good companies, but Cortland's sort of, I think, a little bit of a different beast.
Yeah, but it's also, don't you think it's also like they see the crop of players out there who really, really want to spend money and scale up in these fields? So look at Blackstone Air Communities, KKR Corterra, right? Apollo just bought Bridge Investment Group. So these are like multi-billion-dollar deals.
Artemis getting bought by Barings. We've talked about a lot of these. I mean, why wouldn't 6th Street buy them? Just saying. Like, they did that big deal for L&M. Like, why wouldn't they do this?
The way that I'm understanding the Cortland thing, if it is growth capital, etc., it would be similar to what they did with L&M, what 6th Street did with L&M, which is like take a minority stake, and now Ron Moelis can kind of run Riot.
Well, I mean, you still let Steve DeFrancis run Riot, I think, here.
Yeah. But so they're, as I understand it, doing it from a position of strength. There are others who are putting themselves through a process maybe from a weaker position where they're we've talked a little bit about how the middle is death.
Yeah.
If you're a small sharpshooter, great. If you're Blackstone, gobble everyone up, great. But the ones that are in the middle, and I would imagine Bell Partners falls into that category, it's like you struggle to do the biggest, best deals and rates haven't gone your way.
Yeah.
It can be very challenging. And from the outside, you may not know it.
Totally. And you may have payroll and G&A that's been expanding at a rate higher than you've been making money on the top line. And that can really eat away at you really quick. And if you go through a couple of cycles without promotes, then it's really tough to pay your people. And if they walk out the door, you're in trouble. And I mean, it's smart on Cortland's part too, because I off the top of my head, I can't tell you how big their fund series have been, but they have real big institutional investors. But if you're able to put a bunch of cash on the balance sheet right now, like that seems like a pretty good idea. And if Steve DeFrancis can crystallize a number and the management team crystallize a number, I mean, good for them.
The way that, star employees are encouraged to go out there in the market every so often and see what they're worth.
I mean, our hobby horse, Prof G, have us on. Every 3 years when you're a professor, you got to go get an offer from another firm. And Cortland is doing really well, and as well as anyone in this space, I guess, can. And like you said, you hit the nail on the head. They're coming from a position of strength. And the best time to raise is when you don't need the money, and the best time to sell is when you don't have to.
That's true. And markets can really smell desperation when it comes down to it. I want to talk quickly about just some other strategies that people are using now to kind of expand the pool of capital available for investment. So I read a piece in Perry, I think a couple days ago, where Greystar, they just launched a private wealth team to expand the net outside of institutional capital. Super interesting.
This has been the holy grail. People have been talking about this in private equity for 10 years. I mean, I remember sitting in a teach-in at the Carlyle Group in 2013 or 14, whatever it was.
Was this before or after Rubenstein almost ran you over?
I can't remember. I wasn't there that long, but he's in there saying that, we have to figure out how to get distribution into wealth channels, because the same reason why every single bro on the internet wants to go buy an HVAC company from a boomer. It's the same reason why Greystar wants to go to every Edward Jones advisor and get, the dentist with $2 million in the bank to put $75K into their fund.
You know what this reminds me a little bit of? That was the genius of Nick Schorsch, American Realty Capital.
Yeah, I mean, it's the same thing with any of these non-traded REITs. If you have the distribution into the retail channel, like it's very sticky. It's there, and there's so much money there too. Like you have to go out and sort of like these sales cycles for institutions are so long.
Can you say more about that? What do you mean by that?
Like you can't just call up, Texas teachers and be like, "Hey, you have a great meeting," and you're like, "Cool, like what's the wiring instructions?" Like that doesn't happen.
You're saying it's like a multi-year courtship before the first check's written.
Yeah, it takes forever, and you're also directly competing against everybody else, and there's a lot of stuff that you sort of can't control. And if you get tapped into the right distribution channel for retail, like it's just the money can just like come in. Think of it this way: this is how all of these syndicators raised all the money.
I swear I was going to go there, and then I said, is this too lowbrow?
No, it's the same thing.
The Sunbelt syndicators tapped into these private wealth channels, right? Whether through feeder funds or whatever they did, Indian doctors, etc. They were able to get wealthy people to give them money, and they were able to go and make a very nice business out of this until it lasted.
Absolutely. And the other thing too, I think, which is important to note, is that the tax laws just changed, and 100% bonus depreciation is back, I think, permanently. Tax savings for real estate are now so stark. If you are a retired person, if you have lots of passive income, not active income.
Actual passive income, not...
Actual passive income.
Yeah, correct.
That can be offset by real estate depreciation. So now the returns have to be so much higher in public markets or even fixed income to get to the same after-tax place. And so I think there's going to be more alts are going to go to retail investors, because if you're like, another thing that drives me crazy is when someone's like, well, I can get a bond at 4.8%. Why would I ever buy real estate at 5%? Well, first of all, two things. One, I've never seen anyone like renovate a bond and get the yield to go up. The second is you're going to get annihilated on taxes unless you buy a muni bond. So everyone's going to figure this out and want to own real estate for no other reason than to offset other passive income, particularly for folks without a W-2.
Correct. So we saw this Greystar story. Who are the people who are suddenly going to be people that real estate cares about?
If you are the head of alternative investing at a big RIA, you're going to be really popular. You might not pay for a meal for the next decade.
Overwhelmed by a massive bank accounts? Most CRA players find tracking cash across banks and project LLCs to be a huge pain. Enter Vesto. With real-time balances, transactions, and cash flow monitoring, Vesto gives you a single, clear point of access for all those accounts. You can see every account balance and transaction in real time and save the headache of logging into each one. Vesto has worked with over 100 CRE firms, and you can go to vesto.com to see how they can help you. That's vesto.com. And tell them the Promote sent you.
Okay, Vesto, I'm going to sign up. Let's go.
All right, so we gave the people what they wanted. We did the thing, and now we're back in New York.
Like Lonely Island said after Michael Bolton first talked about the Pirates of the Caribbean.
Yeah, that was kind of weird, but we're back in the club.
We're back in the club, baby. All right, so New York real estate has forever been the world's investment playground. And not just private money. State money from all over the world has found its way into our towers, right? The government of Iran owns 650 Fifth Avenue, and that's been a big controversy. So many different governments have their money piled in here. And one in particular we're talking about today is the Pakistani government. The state-owned airline of Pakistan, PIA, owns the Roosevelt Hotel. And this is one of the strangest assets in New York at the moment. Giant hotel, like it's 1,000 rooms now, but I think it was way more than that at some point.
Who even knows exactly how many rooms there are? If you do an asset walk there, actually that'd be really interesting. Whoever, JPMorgan, if you buy this and you need help on diligence, I just would like to do that out of curiosity. So I'm available.
Why are we talking about the Roosevelt shuttered hotel? It was controversially turned into a shelter for migrants by NYC, and that deal is basically coming to an end, which is why this hotel is now one of the most coveted assets in all of New York.
I think there's one person who might covet it more than anybody else.
Jamie Dimon, the patron saint of New York office landlords. So the Promote learned last week that among the advanced proposals to buy the Roosevelt is JPMorgan. Let's just try to paint the picture here. Now, JPMorgan, they already control over 5 million square feet in a couple blocks? Well, right? It's
right around, it's right around 270 Park there, the giant Norman Foster tomb that they're building for Jamie.
Yeah, so they did a tear down of 270, and they're building a 2.5 million square foot tower there. They bought 250 Park.
Let me just stop for 1 second. Everyone go Google Norman Foster New Yorker profile. It's so good, and it talks at length about this building. And one of the lines in there that has stuck with me is there's a lot of bronze being used in there in this building. And someone very high up at JPMorgan, the author, heard say, well, like, how good is Norman Foster? It's like, well, if you can sell bronze to Jamie Dimon.
Yeah. So I think, you know how we talk about a lot of real estate development giants sort of being in the mold of their founder. When it comes to the banks, like JPMorgan and Jamie Dimon are so synonymous with each other. Like I could probably name the CEOs of the other big banks, but not really, right? But Jamie Dimon and JPMorgan, it's like the chief capitalist of America is the way I think about Jamie.
He's the non-treasury secretary.
And when he came out and said that working from home is for numbnuts, basically, he went on this Hall of Fame tirade about how it was killing creativity and killing collaboration, whatever.
A lot of you were on the fucking Zoom, and you were doing the following, okay? You know, looking at your mail, sending texts to each other about what an asshole the other person is.
New York office landlords, I mean, you could hear the excitement and the gratitude for Jamie.
I mean, he knows how to play to his audience because a lot of that,
he absolutely does.
Because a lot of those guys, he's lent money to.
So he mandated a return to office for his employees 5 days a week. This is a few months ago, and you can see kind of all the plays they're making in Midtown. So 270 Park, 2.5 million square feet. They bought 250 Park right next door, and after the rezoning's kind of all done, you're looking at almost 1 million square feet there. They own the Bear Stearns headquarters, obviously, at 383 Madison.
Famously, when they bought it during the Great Recession, they're like, you bought it for less than the value of the building.
Yeah, it's true. And then, so they have 383 Madison, and then they have 390 Madison, which is their private wealth arm. So if you put those all together and you add all the bonuses and density, blah, 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 you end up with about 5 million square feet already. So it's already one of the most impressive corporate campuses that I can think of in New York history, really. And now the Roosevelt, no one's going to run this shit as a hotel. It's a fucking disaster. But if you can tear it down and redevelop, etc., you're looking at anywhere between 1.3 to 1.5, 1.6 million square feet, which means that Jamie Dimon would have 7 million square feet in Midtown Manhattan.
Think of the people in there 5 days a week. That's so many.
I think we should talk about why this is a little messy, or more than a little messy. The seller. It's primarily the seller. It's the government of Pakistan. And if you follow Pakistani politics at all, it's a full contact sport. It's wild.
Yeah, I'm going to have to let you go on this because I'm not exactly up to date on the latest from Islamabad.
Well, it's just, so they've had many different governments, many different types of governments, a dictatorship that turned into a democracy, then a kind of a puppet democracy. It's crazy. And they've had like half a dozen new governments in the last, call it a handful of years. So each time there's been, and oh my God, where do we even begin? There's been at least 2 prime ministers that have been assassinated.
That's also right about when the PAA got into the building after a lease with a purchase option from the Milsteins.
Yeah, so they come in the late 70s. They basically had a deal with the Milstein family, the New York dynasty, and they come in, but they had an option to buy, and their partner on this deal was one of the Saudi princes. They exercised their option in 2000 to buy it, not without a pretty spicy court battle with the Milsteins.
Oof. Speaking of full contact sport, lawsuits with the Milsteins is up there.
Yeah, so every time the government of Pakistan has looked to sell this asset, this is one of their most prominent external trophies, and it's also, I guess it has a lot of like symbolic value as well, right? Like the heart of Manhattan, you own something like this. Every time they've tried to do this, there's been some government kerfuffle that has replaced prime ministers, replaced ministers, and then replaced the head of the state airline as well, which means the asset's been like in and out of the market for, I don't know, almost 3 decades now.
I think that's right. I think they put it up for sale. I think it also depends quite a bit on the profitability of Pakistani airlines.
Correct.
So I think in 2007, the airline lost like $100 million in the first 9 months of the year. And like, hey, we should sell this hotel that we have. I think they tried earlier than that. In like 2003, I think like Vornado and Related, and I think the current president expressed interest in buying it.
I mean, pretty much anyone in New York real estate has looked at this thing at some point.
And this is a hotel where you could lose $200 million like in a minute. Like, we're trying to renovate this thing.
Can you imagine the carpeting? Like, I'm just trying to picture the carpeting of this hotel. It's like The Shining is what I'm thinking of right now.
Come play with
Yeah, God. And just think of it this way. Like someone was talking about, I think it might have been Antonio from Mad Project on Twitter about budgets for construction. And someone's like, how much could paint cost? Like $50,000? Like what? It was like $2 million in the project. Like what does it cost to just, if you're like, hey, I just want to repaint the Roosevelt. I want to repaint 1,200 rooms. I mean, it's so much money.
Yeah. So you have that. You have the union component. So Hotel Trades Council, Local 6 has some kind of clause in here where the end user would have to pay a pretty nice, chunk of change to operate this as another kind of property. There's a lot of complex moving parts here, and any buyer would have to figure those out. I mean, obviously, JPMorgan has the kind of money that can make all these problems go away.
Well, they got the money, they got the governmental affairs, they got the lawyers, they can make all of these things go away.
They got the juice. And so Peter Regardi of JLL is leading a process, but as I understand it, it's not just Mr. Peter Regardi. It's like JLL's capital markets team. There's a consulting team. There's like, just like the Pakistani government, there's like multiple arms of JLL that are trying to figure this thing out.
Can you imagine the liens?
Can you imagine the Diet Coke budget?
Can you imagine the title search?
Yeah.
Reams of paper. But yeah, it makes sense for them. I mean, look, Jamie wants to consolidate here. I mean, 7 million square feet is a ton of square feet, but just how many employees does JPMorgan have in New York right now? I don't even know. I'll just Google it right now. I mean, they have about 40,000 employees in New York. So even if they hot desk everyone at 150 square feet per worker, they got more than enough for everybody.
Yeah.
By the way, also, do you know who the lender that they most recently refinanced the Roosevelt with?
The Pakistanis?
Yeah.
I think it was JPMorgan.
Ding, ding, ding.
Yep. So the proposal that's in play at the moment, I believe, is a ground lease. And we talked extensively about ground leases when it came to 625 Madison and Ashkenazi and SL Green. Why would PIA prefer a ground lease here? Like, what's the reason?
Probably taxes. I'm sure they've owned this forever. I'm sure. And I was looking again, just flipping through right before we got on this, and I think it lost like $37 million in 2020. Zero idea what the org chart looks like on this. But my guess is if they want a ground lease, it's probably for a tax reason. So basically, it's the same thing that happened at 660 Fifth Avenue with Brookfield, where they took out the Kushners by basically prepaying, 100 years of ground rent. So it's not a sale because there would have been enormous tax consequences for it. That would be my guess.
Yeah, that's kind of, that sounds about right.
But I also don't know, I don't know where the airline is chartered and what the tax laws are there.
There are so many ifs in this deal, right? It's PIA. The government could change tomorrow. Imran Khan could come out of prison, take over, and then suddenly this thing is off again. Who knows? But if this does consummate in a deal, we're looking at, I think, the most impressive campus in current New York City. Like, we have Google on the west side, right, with St. John's Terminal, Chelsea Market, etc. This is even more substantial than that.
Yeah, and it's right in the heart of everything, and it's on Park Ave. I mean, you own 7 million square feet of park in Madison. I mean, it's kind of jaw-dropping. And think of it this way. I mean, how big is one Vanderbilt? It's what, 2.5 million? 3 million square feet?
Close to 3 million square feet.
Right, so this is basically, 2 1/3, one Vanderbilt.
One Vandy's.
Just for JPMorgan.
I think I want to close this one out by imagining what, 20, 25 years from now, what could that look like? Like, what does a perfectly executed Jamie Dimon Kingdom in Midtown look like? Let's paint a picture.
A lot of bronze. He's built the biggest, baddest bank, widely considered the most well-run, and he wants to control his own destiny. He wants his people in 5 days a week, and this is going to be the legacy. When you step off the train and you look up Park Avenue and you just see the JPMorgan glittering campus, I mean, that's, the value of that is ineffable.
When you step off the PIA flight from Islamabad and you see the JPMorgan campus, that's what you meant to say. Okay, so we're going to close out with this giant triple net lease machine deal, right? Starwood is buying fundamental income properties from Brookfield for $2 billion and change. Why is it interesting outside of another example of AUM gobbling?
So Starwood Property Trust is sort of a really interesting company. It was formed, I think, pretty much as a dark pool post GFC. Blind pool, sorry, not a dark pool. A dark pool, I think, is what you trade blocks of stock in, if I remember from Flash Boys.
That's correct.
The blind pool basically said, trust us, we're going to do smart stuff. There's sort of, I think, best known for their mortgage business. So they're lenders on a lot of different things, which we've talked about on the promote. They also have a pretty big equity business too. So they own a large portfolio of affordable housing. The fund series for Starwood Capital Group, and not just them, it's writ large. There's not a ton of promote, probably in the vintages like during COVID or the ones that have been raised recently. And then now fundraising is difficult for almost everybody. So where does the profitability come from? Where do the fees come from? And I think growing STWD has sort of been a big focus point for Barry over the past handful of years. And this is a way to do it. So it is, STWD pays an enormous dividend. It's got to be like 9%, something like that. But it mostly covers it, if not all the way covers it. And it can sort of like adjust its profitability up and down because they could sell off some of their multifamily if they needed to and sort of manufacture it that way. So buying this makes sense from that perspective because net lease has yield.
We should talk about what they're getting here. They're getting about 12 million square feet. So
they're getting
450 plus properties.
They're getting 467 properties, 12 million square feet, 44 states, 56 industries, 92 tenants, 100% leased. And what's, I think, stood out to me the most is that there's a 17-year weighted average lease term with 2.2% average annual rent escalations, like kind of low growth income. Also, what was interesting is that in the statement, Jeff DeMonica, who's the president of Starwood Property Trust, said, what did he say? So this is, again, in the official IR statement from Starwood Property Trust, we anticipate this investment to be accretive to distributable earnings. Phenomenal. After giving effect to projected refinancing of existing debt and projected acquisition volume.
This is a classic unquotable quote. This would be like a promote no-brainer. But what does it mean?
It means it's not going to be accretive, basically. So basically they're saying we're going to refi their entire debt stack to give them a cheaper cost of capital. And then we're going to buy a bunch of stuff at high yields and that'll make this accretive. That's the short version. But again, like it's not going to be, a huge cash flow geyser right away. They admit it as such. But
how did the stock do on this announcement, by the way?
I am pretty sure it went down. The whole math of these public REITs, and again, friend of the pod, Hunter, can talk about this more eloquently than I can, but you basically have, here's what our assets are worth, and then here's what the stock market values us at. And if you're buying things that are more expensive than what the market is valuing you at, that's bad.
Should we talk just for a second about like triple net lease properties and what the juice is there?
Oh yeah,
because
they are.
Just in case we have some casuals on the call.
Totally. So triple nets basically are the operating costs for a property. So if you buy something and it's a triple net property and you're the landlord, let's forget about like complicated lease scenarios, but basically you just get a check every month. The tenant pays the taxes, they pay the insurance, they pay to landscape it, they pay for snow removal, they pay all that stuff, and you just sort of, again, get a check. They call it mailbox money. It's that sort of thing. Like if you owned a ground lease McDonald's, like just you were going to get a check every month, and it was great. Life was grand. However, the problem with these things are twofold. The first is your return is pretty locked in. They have general escalations in the lease, but if inflation is higher than your escalations, and some of them are tied to CPI, which gives some protection, you're losing money on the real basis every single year. The second is if you also have to be a credit analyst because, it sounds great to have a 15-year lease, but if it's leased to like Grandma Bessie's special liver and bratwurst company, and it has no other locations and no earnings and no nothing, that credit's pretty bad. So how valuable is this lease? And some things that would look really creditworthy could not be. I mean, think about all the restaurant chains that have been private equity owned. Think of all the Rite Aids that people bought thinking
Circuit City, etc. Right? Like, things can happen.
Yeah, things can happen. So yes, it's great to have predictable income, but if the credit's terrible, like kind of doesn't matter.
Okay, bring this home for us with the Starwood Brookfield deal.
they're having this thing that's not very management intensive. There was only 28 people at Fundamental Income, which is for a platform that just got bought for $2.2 billion. Like,
So
is not
fucking hell, man. Well done to them.
Yeah, it's very lean because again, it's like we joked a couple of weeks ago where if you worked for the Goldman family in the 90s, it was the best job in real estate because you just had to worry about getting paper cuts from all the checks you were opening.
But man, what's the valuation per employee here? That's got to be pretty damn impressive.
Yeah, it's pretty good.
Yeah.
But the point being, they can't renovate this. They can't increase the cash flows outside of the 2.2% contractual rent increases. The way it's going to work is like if they can go buy stuff at higher yields. But the reason I talked about the credit earlier is that the higher yield stuff, like that's sort of what creates the problem over time, because eventually the higher yield or the higher cap rate assets, there's a reason for it. And so we've seen this over and over again in REIT land where you keep trying to raise the dividend, so you keep buying higher cap rate stuff to cover it, and you buy worse quality stuff, either worse quality real estate, worse credit real estate, and then at some point it just sort of implodes on itself. So it can be a very dangerous game to play.
I think you're being a little too pessimistic, because if you think of what Barry Sternlicht said about this deal, here's what he said. The acquisition of Fundamental marks the next evolution, but not the last for our platform. So he's probably got some more tricks up his sleeve.
No, they're going to go buy a bunch of stuff. They're going to refinance it. No one's, better at playing the capital markets than these guys. So they're going to do a good job. But all I'm saying is that this isn't a magic bullet. Like, no one has solved investing here. Like, there's still risks.
That's it for the Promote podcast this week. A shout out again to our sponsor for this episode, Vesto. See how its service gives CRE players a single, clear point of access for all their bank accounts by going to vesto.com. That's vesto.com. We'll be back next week as always with more CRE insider goodness.
Reminder, hit us up at partnerships@thepromote.com if you want to reach our audience of C-suite executives, frustrated acquisitions guys, VPs at brokerages.
VPs at brokerages, it's like the most table stakes audience you can get.
But that is how many people listen to this podcast. Think of all of them.
That is true. That is true.
And please like, share, subscribe to the podcast so that more people can find it.
Will is like watching these charts like a fiend. I have, I've started meditating and I try to stay away from this shit right now. But yes, we both really care. And listen, guys, we should also say thank you so much for being such an obsessed audience. It is a pleasure to pod for you guys every week. And Will, thanks for being such a maniacally fun co-host, dude. I love you.
Thank you for asking me to do this. It's really been a treat.
Ciao.